Today, we're going to do a little forensic investigation. We're diving into this one small number you might see on your tax forms, a foreign tax payment. Now, it might look totally insignificant, but as we're about to find out how you handle it, well, that can have some surprisingly big consequences for your wallet.
So, picture this. You're going through your documents, and you see it on a statement for a stock you own, maybe like Verizon, or from an international ETF. And that little line item, foreign tax paid, can be, a little intimidating. Your first thought is probably, oh no, do I have to fill out that dreaded, super complicated Form 1116? Well, that is the central question we are cracking open today.
And you know what? I'm just going to give you the answer right up front. For most of you in this situation, this is pretty much an open and shut case. For a small amount like this, you can almost certainly bypass that complex form entirely. So, let's look at the evidence. See, the IRS has this special exemption for small amounts, kind of like a get-out-of-jail-free card. They call it a de minimis rule, and it lets you skip Form 1116. To qualify, you just have to check 4 specific boxes. So let's break them down one by one.
As you'll see, these conditions are usually pretty straightforward for the average investor. First, the income has to be passive. Think dividends or interest. Easy enough. Your total foreign taxes have to be under a certain limit. Check. It all has to be reported on a standard form like your 1099. And finally, you just need to have held the stock for at least 16 days. For most of us who buy and hold, these are really easy boxes to check.
So, what's that key dollar threshold I mentioned? It's just $300. If your total creditable foreign taxes are $300 or less as a single filer, or $600 if you're married filing jointly, you're good to go. So yeah, our $200 example fits comfortably inside that limit. Okay, case closed, right? We can all go home? Not so fast. Skipping the form is just the beginning. This is where our little investigation uncovers a crucial fork in the road, a decision that can have a major impact on how much tax you actually pay. So, here's the choice. You can take a foreign tax credit or an itemized deduction. And I have to be clear, they are absolutely not the same thing. One of these paths saves you way more money. The other one, well, it might seem simpler, but it's what we'd call a forensic trap. So the most important thing to get your head around is what a tax credit actually is. It is, hands down, the most powerful tool in the entire tax code. Why? Because it's a direct dollar-for-dollar reduction of the final check you have to write to the government. It's basically like a gift card you get to hand straight to the IRS. Okay, this chart shows you what we call the delta. That's the real, cold, hard cash difference of making the wrong choice. With the $200 credit, you save, well, the full $200 on your tax bill. But if you take a deduction instead, you're only reducing your taxable income. So for someone in the 22% tax bracket, a $200 deduction only saves you $44 in actual tax. That's a difference of $156 that you're just leaving on the table. And hey, you don't have to take my word for it. This evidence is straight from the horse's mouth. The IRS's own field guide, Publication 514. They say it in black and white. The credit is almost always the better way to go. So that begs the question, right? Why on earth would anyone choose to save $44 when they could save $200? Well, it usually comes down to a classic behavioral trap. We humans tend to choose what seems easiest or most familiar, like just slapping a deduction on Schedule A. We do it just to avoid what we think will be a hassle, even when there's no complex form involved. But here's the thing. This easy choice comes with some serious hidden risks. First off, you only get any benefit from the deduction if you itemize. And with today's super high standard deduction, most people don't. And second, it can clash with something called the alternative minimum tax, or AMT, which could, get this, actually increase your tax bill. It's a trap that can cost you way more than you save. And the risks of making that wrong choice, they don't stop there. We've been talking about a small, correctly reported amount. But what if an audit turns up other unreported foreign income? That's when a tiny mistake can snowball into a massive problem. This is a concept we call the double torpedo. And yeah, it's as bad as it sounds. It's this devastating financial chain reaction where one problem, like an audit changing your income, triggers 2 other huge financial hits. It starts with something that seems so small and just spirals out of control. So check out this domino effect. An audit finds some income you didn't report. That makes your adjusted gross income, or AGI, go up.
that higher AGI suddenly makes more of your Social Security benefits taxable. And at the exact same time, that higher AGI can kick you into a higher bracket for your Medicare premiums. That's known as IRMAA. Boom, boom. You get hit twice, all from that one little thing the audit found.
All right, after looking at all the evidence in our investigation, from the simple rules to the behavioral traps and these really high-stakes risks, we've reached a very clear, very decisive verdict on how you should handle that $200 foreign tax payment. The verdict is simple, and it's powerful. Number 1, as long as you meet those 4 simple criteria, you do not need to file Form 1116. Number 2, always take the full $200 credit. You just claim it directly on Schedule 3, Line 1 of your tax return. And number 3, avoid the deduction trap. It's just financially inferior. Don't leave that money sitting on the table. So, we've officially closed the case on the $200 foreign tax. But it leaves us with one last, kind of provocative question. This entire investigation started with just one small number on one tax form. It really makes you wonder, doesn't it? What other little, seemingly minor details are lurking in your finances, holding hidden risks, or maybe even opportunities? Understanding this stuff isn't just about saving a few bucks, it's about protecting your entire financial future.